Well, passive flows, superannuation and algorithmic trading are now a dominant force in markets. But if more money is following rules rather than analysing fundamentals, what does that mean for price discovery? In this segment, we break down what's really driving volatility and whether markets are becoming less efficient as a result. And joining me today is Andrew Coleman from Teaminvest and also Mark Lamonica from Morningstar. Great to have you both with me today, gentlemen. Well, let's start then with you, I guess, Andrew. Passive investing, do you see it as an evolution or a distortion?
Well, I think it's both. So, I mean, really, probably it's worth starting in the beginning. Passive investing is just simply defined as investing by mimicking a published index. So rather than trying to pick individual winners or losers, you're trying to follow a general theme, whether that's the market as a whole, say the ASX 200, or a commodity theme, or an IT theme, or a real estate theme. And it's important to note that it's a relatively new thing. I mean, index investing really only started in the 1970s, really, with Jack Bogle. But today represents more than half the money involved in both the US and the Australian market. And in fact, if you look at the amount of money that's index aware, so that means actually following the index or following most of the index with one or two exceptions, it really now is the single biggest driver of capital flows in both the Australian, US and European markets. And you see that by when you look at the number of mandates being appointed as well as the estimates of total amounts of capital.
So, Mark, you've written a really interesting piece on this, saying that we can see some distortion or it can be less efficient. Just explain for us.
Yeah, I based the piece on a study that came out called Passive Investing and the Rise of Mega Firms. And the authors of the study looked at data in the US between 1996 and 2020. And basically what they did is they measured or attempted to measure the impact of the shift into passive investing. And so there were lots of different results, but one of the things they found is that the 50 largest shares in the US, they outperformed by 29% over what they would have if it wasn't for these passive flows. And they also found that simply an investor reallocating from active into passive would actually push the market higher because, of course, passive investing, those large capitalization stocks get more of every dollar invested, where active investors obviously are trying to find where they perceive value throughout the market. So it does show that there were certainly impacts from this big shift towards passive investing.
And what does it mean, Andrew, as well, for volatility?
Well, in theory, passive investing, once it reaches a certain point, will break the market. I mean, Jack Bogle said in 2017 that and Jack Bogle being the founder of Vanguard, the world's first and largest passive investment company, said that if everybody indexed, the only word you could use is chaos and catastrophe, but it's not going to happen. And that's really borne out if you think of it quite logically. If no one's out there doing price discovery, everyone is investing based purely on size of market cap, then you're going to get more and more surprises because no one's digging under the hood to find out what's going to happen before the surprise occurs. This chart that we've got up here shows, for example, the intraday volatility around reporting season for most of the last reporting periods. It actually doesn't have the most recent one, which is highest still, but was the 3, 6, 8 reporting periods prior. And what that chart is really showing is it's showing that as we are moving more and more towards a passive investing dominated market, so too is intraday volatility increasing materially, in fact by about 40% since February 22 around reporting season, which ties in with that sort of theoretical idea. If no one's out there trying to predict, or a very small amount of people are out there trying to predict, is this company going to have a good or bad year? Well, then the first we know about it is the result, and that creates a very large movement where, of course, the efficient markets hypothesis states or implies that all of that information would have been gathered before the day of the announcement, and there should be no surprise at all. So you can sort of compare them as the two alternatives. In a market driven entirely by active investing done well, big caveat, done well, there should never be a surprise around an earnings announcement. And in a market driven entirely by passive investing, there would always be surprises. So the question sort of is where do we sit between that and what can we do about it? You know, Mark mentioning your paper, but there was another interesting paper last year by Salmon et al. In the Journal of Management Science, and I'll give you a quote. It said that passive ownership negatively affects the degree to which stock prices anticipate earnings announcements, and the rise in passive ownership over the last 30 years has caused the amount of information incorporated into prices ahead of earnings announcements to decline by approximately 25% of its whole sample mean. In other words, our ability to predict rationally what should be occurring has been materially impaired as just less people are looking.
And to your point there where you say people maybe not looking under the hood, Mark, what does this mean then? Is there less incentive sometimes for investors to maybe do their own fundamental research?
Yeah, I mean, I think there's different ways of looking at it. I think some of the passive critics look back at the pre-passive time as this investing utopia where these very smart investors were rationally assessing companies and making the right decisions. And, that wasn't true. And I think that, the market is obviously complicated. There are investors with all types of different goals and motivations. Some people are day trading. Some people are long-term fundamental investors. And so you get this mix-up of all of these different things people are trying to accomplish. And I think, when we say passive investing, if we go back to Bogle, which we've obviously been talking about, his view of passive investing is the thing that was passive was you. That you weren't making any decisions. People are using passive products and they're trading them. And so I think to say that passive investors are not fundamentally driven or not driven by fear and greed and all the emotions just isn't true. People are using these products to do lots of different things with them. So yes, I think that it does change the market dynamics, but I think as a long-term investor, the fundamentals still matter. So, that study that I cited that said the top 50 shares had gone up 29% more than they should have over that very long time period. Well, the market went up 850% during that time period. So it influences markets, in my view, but it is not the sole driver. And I do think that over the long term, it still is fundamentals.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. Masterclasses held across 9 cities. Register your interest by clicking on the link in the caption.
What about the concern, though, either of you, that passive investors can then sell everything in a downturn and you could see a crash?
Yeah, look, I don't think that part will happen, but I think what really is interesting, and Mark sort of touched on it, so I just want to draw it out. There's 2 different ways of looking at this problem as to whether it's good or bad. The first is from the investor's perspective. Is this good or bad? Is this going to enhance my returns? And I would say that the rise of passive investing has been wonderful for returns, both for passive investors and for active investors. For passive investors, because it's given them a product that they can sleep easy at night that will achieve a meaningful return, not wonderful, but good enough. And for active investors, it's given us that beautiful example of playing poker at a table with a group of patsies. If you know that the vast majority in the market is investing, buying or selling based on things other than the fundamentals, your edge by understanding those fundamentals has just materially increased. So from that point of view, passive investing has been wonderful for value investors. What it hasn't been wonderful for is the purpose of the market as a capital allocator. Because in theory, the market should be allocating capital to the very best ideas and the very best management teams and acting as an engine of creative destruction to drive economic growth. If it's not, and the vast majority of money is going simply to the biggest things, as opposed to the best ideas with the best management teams, or going there because of themes rather than fundamentals, then you will see, and we are seeing, a material decline in both the efficiency of the market, okay, tick academic box, who cares, but more importantly, a material decline in economic productivity. And I think that, to a large extent, is perhaps responsible for part of the economic malaise that we found ourselves in for the last 20 years.
What about some of the benefits, Mark, though, that might outweigh risks, potentially lower fees, some strong outcomes here too?
Yeah, I think the important thing to remember is, passive the rise of passive investing hasn't happened in a vacuum. Most active managers are underperforming. So I think, as much as we want to sit there and paint passive investors as just people plowing money into the market and pulling it out, and they're unsophisticated and there's all these ways we characterize passive investors, but ultimately I think they're making a rational decision. Why should I pay higher fees to a manager that is unlikely to beat the market? So I think overall it has been a benefit for investors. I agree with some of the points about capital allocation and kind of this feedback loop where large companies are getting more funding, so of course they're doing better, and like all of that I think is true. But I think just from an investor standpoint and me trying to grow my super, I do think it's a positive thing.
And if there is a little bit of distortion, does that create opportunity for value investors potentially elsewhere?
I mean, there's always been distortion, but yes, I do think it creates an opportunity. And an example, and this is personal, this is my personal investing, not Morningstar, but I'm an income investor. And so when I sit there and say, okay, if there are distortions, if we're going to start to look at mid caps and small caps, there's potential distortions, and maybe that's an opportunity where I can get a higher yield and more dividend growth than potentially I could have before. So if I am focused more on income and not necessarily passive flows driving large companies, then maybe that's an opportunity for me to distort that.
What do you think about that?
Yeah, well, I said before, I think we need to separate the winners and losers at a personal level, the investor level, from the economy. The economy loses by this, but individual investors often win. The person who used to get taken advantage of by a shonky broker now has an opportunity to just own a passive fund, achieve the market return and be safe. That's not good for business, but you would say it's only fair for Mr. and Mrs. Jones, who otherwise were, being hurt by some unproductive parts of the market. I think the challenge, though, is that anything where money is moving based on rules opens itself up for targeting by unethical actors. So what do I mean by that? I mean that if there is a bunch of herd doing one thing, it's very easy for the dishonest person to try and take advantage of that, to game the system, in other words. And I think that to some extent, the risk with passive investing, other than the return being good but not great, and you can argue whether that's good enough, that's a personal choice, it depends where you sit in that spectrum, right? But the biggest risk by far is the ability for the market to start becoming co-opted by more and more sharks who take advantage of the knowledge that less and less people are looking. It's much, much easier to commit a scam when no one is asking questions, and it's much easier to manipulate the market when the market doesn't have the participants asking questions. Are we at that point yet? I have no idea. Potentially Shield and First Guardian are examples of that. Certainly, I think there are some other big accounting scandals at the moment that are examples of that. Is that at a point, though, that it's any worse than any other period in history? I don't know. People have been bad actors, since time immemorial, right?
Yeah, absolutely. The other point, though, and you mentioned herd mentality there, do you think, Mark, that means that some of the bigger companies could be disproportionately affected or benefited, I guess, because passive flows tend to go to some of these bigger companies?
Yeah, I think on either side, right? And I think a lot of the critics around passive investing are worried about this mega bear market that happens. Now, part of this is they've happened in the past. If we look at an 80% drawdown in the 1929 crash, we look at what happened during the GFC, the market has shown it can fall significantly without passive investing. But I think that's the fear. And right, so if these firms benefited when there was a run up in the market, then if there's money coming out, they of course will disproportionately be hit. I think that ultimately, I guess through a market cycle, that's just the new normal and something we need to get used to. It's not something that necessarily keeps me awake at night. I never thought there wouldn't be bear markets. I think there will be bear markets going forward. So yeah, it's not something I'm that worried about, but yes, it should have an effect on the way down as well.
I guess, final question, both of you, would we be better off without passive investing?
Completely without passive investing? No, I think there's a place for it. I think there's 2 points to it, though. There's where do you sit in the spectrum of using it as a product? So, there's that lovely quote, and I know, Mark, you've said it before, it's sort of the classic one, 80% of active investors fail to beat the market after fees. Well, of course, 100% of passive funds fail to beat the market after fees as well, because they're holding the market, and as long as they charge a single basis point of fees, they have underperformed it. So it's a little bit of a false dichotomy. But having said that, like the Dunning-Kruger effect in Swedish car drivers, where 85% of them said they were better than average. Don't ask an active manager if they're better than average. The answer is always yes. And that cannot be true. So if you're an investor who either is not confident that you're better than average, or perhaps their returns, even if your confidence is high, don't say you're better than average, then a passive product is a much better approach than continuing to get a worse return. Having said that, there are certainly risks you have to be aware of, both as the investor using the product and as regulators and the market. And I don't think as a society we have yet confronted those. And the four key ones for me would be, we will expect, as passive investing rises, to have greater and greater volatility in the market. That's starting to happen, I think. Now, maybe that's not as high volatility as 1929, but in the long run, you should have, on average, higher volatility. Secondly, you can expect that bubbles will get larger and continue longer, and crashes would, in theory, in the converse, be deeper and continue longer. Thirdly, as I mentioned before, I think you could find more scams and smoke and mirrors in the market. And then lastly, and perhaps most confrontingly from just a personal political point of view, we should see rising wealth inequality, because the differential between the haves and have-nots, when there isn't price discovery, accelerates based on your initial starting position. It's just basic mathematics that'll do that. Now, that's not necessarily a problem for any individual investor, that's more a problem for society as a whole, but it certainly feeds into that narrative.
And I guess this is just asking you to sum up your article in like 30 seconds.
Yeah, I mean, I think overall passive investing there's been a lot of benefits, namely lower fees, even for active products. My worry is investor behavior. People think they're investing passively. They're not. They are going risk on, risk off all the time using these passive products. So my worry is that all of those things that really hurt individual investor returns, they're exasperated by passive. And so that concerns me a little bit.
Great to chat, gentlemen. Really interesting stuff. Andrew Coleman from Teaminvest, Mark Lamonica from Morningstar. And next up, we go head to head.